Hi folks, part 3 from chapter 4. So now we're going to talk about big data and data analytic techniques, that you could use for skimming. So check this out. So some of the things you could look for: summarize net sales by employees. Take a look at the top 10 with low sales. Maybe they're deleting some of their sales. Summarize by location: discounts, returns, inventory adjustments, write-offs, and voids. So again, you see what we're doing. We're not necessarily saying that they did anything, but it starts to be an indicator. Again, employee discounts, returns, write-offs, and voids. Top 100 employees by dollar size. Those who have been on the list for 3 months. Locations that have been on there. So what we're doing is we're trying to use the data to indicate a direction. Okay, it may mean nothing, but the whole point is using the data to help analyze. Analyzing without the software or something like that, that it would be much more difficult. Okay, standard deviation for each employee. Adjustments to inventory by each employee. User transactions, summaries, segregation of duty reviews, user access for sales, accounts receivable, percentage of assigned to unassigned time for employees. Again, look at, all these things we're looking for little outliers. Okay. Telephone logs during non-business hours. Percent discounts summarized by employees. Invoices with partial payments. Open invoices. Customers with no telephone or tax ID number. By the way, usually when stuff like that happens, they're fraudulent, right? Somebody made them up. Identify customers added during the period under review, right? Any new customers. Customer master file to employee master file. So, again, we're looking to merge these and see where there's discrepancy. Okay. Now we're going to switch over. Now we're going to take a look at cash larceny schemes. Okay. So basically, when it comes to cash, there's 2 types of things. One is skimming. One is larceny. And larceny by law is taking away an employer's cash without consent and against the will of the employer. So, they're related, but larceny is a little bit different. Okay, and larceny, money has already appeared on the victim's books. So, see, with skimming, it's before it was on the books. Larceny means it was on the books already. Okay, whenever employees have access to cash, most involve theft of cash at the sale, incoming receivable, and organization's bank deposits. So the difference between the larceny and the skimming has to do with the timing of it. Okay. Now, at the point of sale, why does it happen? That's where the money is. Okay. So what would be larceny at point of sale? Theft from cash registers. Small, like this death by 1,000 cuts. Those are little small people stealing small amounts of number, large people. Reversing transactions, voiding a transaction out. Destroying register tapes, altering cash counts or register tapes. So again, this is when it's already been into the system. Okay. So let me make this a little bigger here. Okay. So employee steals from the cash register. So what can they do? They can, using their own register and access code, using another's, right? They conceal the theft. How do they do it? How can they conceal it? Personal checks to replace missing money. Reversing transaction. They stole the sale, so they made it a refund. Alter the tape. Falsify the cash account. Destroy the tape. Okay, that's a little destroying the tape. That might be. And then false voids and false refunds. Again, when I make that video, I have some stories to tell you about this as well. But by the way, these things do happen, and the more internal controls you have, the less likely it is to happen. But nonetheless, they can still happen. Okay. What about thefts from other registers? Take money from somebody else's register instead of your own. Okay. So in retail, most there are sign-in registers. One is used. Each employee has an access code. Again, those are all internal controls. The smaller companies tend to violate those things. I mean, I'm sure if you ask the folks that you know, did they ever work in fast food or in retail, and say did they always follow all those rules, or did somebody just take over your register? I could tell you, I'm sure that happened a lot. So here, death by 1,000 cuts. What are they talking about? Stealing small amounts over an extended period of time. $10, $50, $100. Because they're small, people think about them errors. Okay? All right? But again, most organizations track it by employee, so largely ineffectual. What they're saying is nowadays they track what happens with each employee to the extent that the employee can't get away with it as much. Okay? Reversing transactions, we talked about that one a little bit. Reconcile the amount of cash on hand after the theft. Okay? Again, normally you would have to get approval for this. So for example, one of the things you could do is that function doesn't work unless an override code is put in, right? So again, you would have to get somebody working with you in order to do this. But if employees had the authority to do this on their own, you see where that could create an issue. Again, internal controls. Altering tapes. This is a bit much. Destroying register tapes. Truthfully, nowadays with computerized cash registers, it's difficult to do. 20 years ago, you could go buy a cash register just like the one that was in the store for a few $100s, and you could actually create register tapes. Okay. Now I think it's much harder to do, so I think this one wouldn't be all that likely. So how do you prevent or detect this? Again, notice strong internal controls, segregation of duties. Follow the rules. The rules are in place for a reason. Discrepancies between sales records and cash on hand, discounts, returns, adjustments, things like this. By the way, that's, oftentimes you could hide, if you stop and think about it, you don't have to steal big amounts, but stealing a couple $100s a day, if you're busy enough, that's a lot of money. If you only work $5,000 a week, that's $50,000 a year from one employee. Okay. What about receivables? Okay, this is when stealing a customer's incoming payments. By the way, that has to do with the story I'm going to tell you. They can hide the imbalances. How do they hide it? Generally concealed through destruction of records, reversing entries and forced balancing. By the way, just to let you know, for that story I'm going to tell you later on, here's what it was: destruction. It wasn't destruction like, in this case, they were deleting. Deleting records. This is how they did it. From the system. Anyway, when I tell you, it's going to be pretty interesting. But anyway, like I said, I'll tell you that story. Let me want to finish these items first. Okay. Forced balancing. Again, this is notice here, control of a company's accounting system. So they have to have some knowledge. Okay. Knowledge about what's going on. They have to know enough about the system. And again, poor separation of duties. This is usually what will allow it. How does that happen? Okay. Destruction. Destroy all the records. Might be, again, this is not necessarily physical records. Could be electronic. So, not like taking paper and, shredding it. Okay? All right, folks, that's part 3. We'll be back with part 4 in just a minute.